James Knightley is with us, Chief International Economist at ING. He's with us. James, good morning. Great to have you with us on the program. Thanks for joining us. Just a quick word, James, on what can we expect? I mean, I think trade and non-trade stuff, geopolitics, it's all kind of sort of mixed in. If you want to sort of identify this one big dominant driver for markets, I don't know if it is really trade and tariffs or if it is geopolitics on Friday. What's your sense, James, if I can sort of ask you a slightly open-ended question?
Yeah, it's there's lots of things in play right now, aren't there? As you say, geopolitics, trade, and of course also we're looking at the Federal Reserve. I think there is a lot of hope and expectation in the United States markets that the Federal Reserve will be able to come in, offer several rate cuts, get some stimulus into the economy, get the economy firing, get corporate profits firing again as well. So I think those are the three factors that we're all really looking at, and that's why I think today's inflation numbers are so important.
Okay, James, hi. Good morning to you. For the US market itself, I mean, so far data has been extremely strong and buoyant, right? Now, as the tariff collection has finally begun, what do you forecast going into the towards the end of the year? What sort of an inflation increase would you expect in the US?
Yeah, well, I think, when we look at the growth backdrop and the inflation backdrop, I mean, at the start of the year, there's a lot of optimism about the US economy, the expectation that it would grow about 2.5% this year. Expectations were that Donald Trump would focus on tax cuts, focus on deregulation. And of course, he hasn't done that. Instead, he's focused on immigration controls, he's focused on tariffs, and he's focused on government spending cuts as well. So very different policy mixes. And that's why we've seen the consensus growth forecast for this year really be cut quite significantly from that 2.5% at the start of the year down to about 1.5% right now. Now, also, inflation has gone the other way. Inflation was expected to converge on target, but now, as you say, these tariff-induced price hikes that we're anticipating, some early evidence of that in June. We're expecting more of that in today's July data. Well, we think that can push inflation probably close to 4%. But that's not going to be a sustained story. We're in a very different economic environment to 2021, 2022, when a similar sort of goods supply shock, i.e., the COVID pandemic supply chain strains. Today, we've got the tariffs. Well, that was really amplified back then by a tripling of the oil price, by a red-hot jobs market pushing up wages, and of course, house prices in the United States rising 50%, driving rents higher. We don't have any of those factors this time around. So I think, we'll get inflation a little bit higher, perhaps close to 4%, but we'll certainly be falling again before the end of the year, and I think falling quite quickly through next year, and that will allow the Federal Reserve to come in and cut rates pretty hard.
All right, James, the last time we spoke, you were a little bit hesitant with regard to the Fed cutting rates. But now going by the softest data and going by what we're seeing on ground, you believe that, maybe 2 or 3 rate cuts could be done in this year itself?
Yeah, we've got to remember that the Federal Reserve is different to most other central banks. Most central banks in developed markets target inflation at 2%, and that's their one job. The Federal Reserve has that, but it's also got to maximise employment as well. And of course, the jobs numbers that we got in the most recent report were subdued, were pretty weak, but it was those 250,000 downward revisions to the previous 2 months of data that really jolted the Federal Reserve. I think, the narrative from Jerome Powell, the Fed chair, had been that the jobs market was pretty solid, the economy was pretty solid. Well, when you've had 250,000 downward revisions to 2 months, and the subsequent story tells us that hiring is concentrated in just three sectors of the economy, private healthcare, leisure and hospitality, and government, well, that doesn't signify a robust, solid economy to me, and certainly not to the market, and certainly not now to most people on the Fed. So I think that change in story on the US jobs market really does open the door to those interest rate cuts from the Federal Reserve.
I think, and later today, we have the CPI numbers, right, James?
Yeah.
Yeah, so we'll see if that is important. So, it'll be a good question.
Yeah, I was just wanted to sort of round it off and ask James for a view on how you're seeing India amidst this tariff turmoil. And very clearly, I mean, we've got one of the worst deals along with Brazil, but then we're not an exporting economy. But a lot of people are talking about second-order potential effects, James, with whether it's fund flows, FDI flows, business confusion, etc. What is your assessment of India, given this tariff standoff as of now?
Yeah, I mean, we've got to remember, I mean, most countries, and India is no exception, do not rely on exports to the US for their growth. Even in Europe, where it is seen as more vulnerable, exports to the US account for barely 4% of total, economic activity. And this is all really quite manageable stuff, especially if you've got offsetting growth from elsewhere. So yes, it's a hit to sentiment. It's a creation of uncertainty. But it can also be a trigger for opportunity. And certainly in Europe's case, for example, we have seen government politicians look to take advantage of that and are driving and striving for their own economic policy away from the United States as well. So it may well help India in terms of diverging and looking for alternative trade partners as well.
And that's exactly what our colleagues in Delhi are picking up. Those overtures have already begun. In fact, yesterday we did report that, for instance, there's a greater cooperation that will be now forged with a lot of other markets, including Africa and the Middle East as well. So let's see how these alignments shape up. Thank you very much, James. Great conversation with you this morning. Thank you for joining in today.